Hello and welcome. Could a US-Iran war trigger a global recession? Imagine waking up tomorrow morning in Chicago or London or in Sydney. You check your phone, your email before you go to work, and the first headline you see: oil prices just jumped to $150 a barrel overnight. Gas at the pump suddenly costs $7 a gallon in parts of the United States. Airlines are warning tickets prices could rise 30 to 40% within weeks, and shipping costs spike. Food prices creep upward. And here is the strange part: none of that started in your city. It started thousands of miles away in a narrow stretch of water between Iran and Oman called the Strait of Hormuz. Now, this is where the story gets very serious, because about 21 million barrels of oil passes through the single choke point every day. That's roughly one-fifth of the world's entire oil supply. So here is the uncomfortable question most headlines are not asking yet. If the United States and Iran slides into a long war, could that one conflict push entire global economy towards a new recession? Stay with me, because the answer is more complicated than it looks. I have spent years studying geopolitics, energy, markets, and uncomfortable intersection where wars start affecting everyday life. Gas prices, grocery bill, mortgage rates. And one lesson keeps coming up again and again. And that lesson is: wars rarely stays on battlefields. I'm Dr. Adeel, and this is In Focus with Dr. Adeel. So let's start with the same question, something most people overlook when they think about war. When we imagine conflict, we picture missiles, aircraft carriers, and soldiers. They are working on the front. But the modern global economy, it runs on something much less dramatic, and that is energy. Oil powers 90% of the global transportation. It moves the trucks delivering food across America, and it powers cargo ships carrying electronics from China to Asia to Europe and to United States of America. It fuels the planes crossing the Atlantic every hour, and the Middle East still sits right at the center of that energy system. Today, the region produces roughly one-third of the world's oil supply. But even more importantly, it controls the choke points, the narrow shipping lanes where energy flows through the global system. And the most important of those choke points is the Strait of Hormuz. At its narrowest point, the shipping channel is only about 21 miles wide. Think about that for a second. A waterway barely wider than many major cities, carrying energy worth 1 billion every single day. That's very unique. So when tension rises between the United States and Iran, the country that sits right on the choke point, markets gets nervous. And we have already seen early signs of that nervousness, not only in the US, but in the entire world. When conflict risk spikes in the Gulf, oil markets can move 5 to 10% in a single day. Now, here is the question that really matters for all of us. What happens if those tensions turn into a long-term war? Because the first domino that falls is always oil. And history gives us a very clear warning here. Some of the worst economic slowdowns in modern history started with energy shocks. If we go back to 1973, during the Arab-Israel War, several Middle Eastern oil producers imposed an embargo on the United States and its allies. What happened? Oil prices didn't just rise, they quadrupled within a year. The United States fell into recession, and inflation exploded over 12%. Unemployment climbed, and economic growth stalled. Now, fast forward to 2008, oil prices surged again, reaching nearly $147 per barrel, the highest ever in history at the time. And shortly after that spike, the global financial system began collapsing. Now, I'm not saying oil prices alone caused the 2008 crisis. There were other reasons as well. But energy shocks have a way of amplifying economic stress. when economies are already fragile. And this is where a US Iran war becomes economically dangerous for all of us because Iran has several ways to disrupt oil flows. They could mine shipping lanes, which they are doing. They could target tankers, which they are doing with drones and missiles. And this is the nightmare scenario for energy markets. They could try to temporarily close the Strait of Hormuz, which they have almost done. Even a short disruption could remove 15 to 20% million barrel per day from global market. To put that into the context and perspective, that's more oil than the entire daily consumption of the United States of America. Now imagine global supply suddenly dropping by that amount. What will happen? Oil prices wouldn't just rise. Some analysts estimate they could spike well above 150 or even $200 per barrel within weeks. And when oil climbs that fast, every sector of economy feels it. Transportation costs rise, electricity costs rise, and manufacturing costs also rise. Food prices rise because modern agriculture runs on fuel. But oil prices are the only first layer of the problem. The deeper issue is something economists call confidence. Economies do not just run on money, they run on expectations. When businesses feel confident about the future, they hire workers, they build factories, and they expand their production. But when uncertainty prevails, especially the kind of caused by war, that confidence disappears quickly. Let's walk through what usually happens in such case of such scenarios. First, energy prices spike. That pushes inflation at a higher rate. Central banks like the US Federal Reserve or the European Central Bank respond by keeping interest rates higher for longer period of time. Higher interest rates make borrowing more expensive, mortgage payments rise, businesses loan costs more, investments slowdowns. Now add another factor. Financial markets hate uncertainty. During geopolitical crises, investors often pull money out of stocks and move it into safe assets like gold or US government bonds. And we saw exactly this pattern during the Gulf War in 1990s, during the Iraq invasion in 2003, and again during the Russia-Ukraine war in 2020. So markets become volatile, currencies swing, and global trade slow. And when global trade slows, growth slows. That's very normal. Right now, the world economy is already growing at only about 3% per year. That's not a huge margin for error. A major energy shock could have one full percentage point of global growth. For large economies like Europe or Japan, that could be enough to push them into recession. But here's where the story takes a surprising turn. Because the United States today is not the same energy consumer it was 20 years ago. Here is the twist most people miss. Over the past decade, the United States has quietly become the world's largest oil producer. And thanks to shale oil and natural gas, America now produces more than 13 million barrels of oil per day. Yes, you heard it right. That's more than Saudi Arabia, more than Russia, which means something counterintuitive happens during an oil shock. High oil prices hurt consumers. Yes, they will hurt, but they also boost parts of American economy as well. How? Because energy companies earn more. Oil producers drill more and energy export rise. In fact, the US is now a net exporter of petroleum products. So while higher oil prices could hurt American households, they might hurt other regions even more compared to the United States. Europe imports roughly 96% of its oil consumption, and Japan imports almost all of its fossil oil. So many developing economies rely heavily on energy imports. So the same shock that America partly absorbed could hit those economies much harder. And if Europe slows down and Asia slows down, global trade slows down. Factories produce less, and shipping volume drop. Stock markets wobble, and suddenly a regional war begin to look like something far bigger. Not just a military conflict, but a global economic shockwave. So let's come back to the central question, which we asked at the start of this video. Could a US-Iran war trigger a global recession? The honest answer is it depends on how long the disruption lasts. If conflict is brief, days or weeks, markets might recover quickly. We have seen that before. But if shipping disruption lasts for months, if oil stays above $120 or $150 per barrel for prolonged period, and if financial markets lose confidence, then yes, we can go into a global recession. So the risk of a global recession rises dramatically in such scenario because history keeps repeating the same lesson. The global economy can survive many things, but it struggles to survive sudden energy shocks. And that's exactly why investors, governments, and central banks around the world are watching the Strait of Hormuz and Iran so closely. This is In Focus with Dr. Adeel.